And good morning, everybody, and welcome to the TriggerCharts pre-market rundown for April 10th, 2020. It's Good Friday. Markets are closed today. I'm Andrew Horowitz. I'm the co-founder of TriggerCharts, and I want to welcome you each and every Friday at 9 a.m. to discuss things related to markets and what's going on around the world, especially now with all the upheaval that we're seeing and all the concern we're having, not only related to the financial markets, but also the health of us individually. So the health of our financial system, the health of the markets, as well as the health of ourselves. So hopefully everybody is actually doing pretty well. There is no trading going on right now in the markets. Markets are closed. The currency markets, I think, are still open, but the U.S. markets are closed today for an observance of Good Friday. So before we get any further, I want to mention, of course, this is for educational purposes only. It's not a recommendation to buy or sell any security. It's not in any way a solicitation of any sort to buy a security or sell a security or a recommendation. Again, it is for educational purposes only. These are also recorded, and we'll have them on both TriggerCharts.com. You can find the library of our Friday morning discussions there, also on our YouTube channel over under TriggerCharts. And you go to the webinars area. So there's a playlist called webinars, and you'll see all of these. So let's talk a little bit about what's going on. Then we'll get down and dirty into some of the areas of technical analysis, particularly using the TriggerCharts tools that we use so successfully on a regular basis. I'll mention at the top, before we get any further, I'm going to put this in the chat right now. I think I hit that. If you want, you can get a 10-day free trial to any of the indicators that we have on TradeStation. So I think it's important to understand that why we are the top rated and usually in the most popular category for indicators on the TradeStation platform, because we get emails on a regular basis thanking us for making not only profits for traders, but also making it easy. I think that's really the key to what we try to establish and what we try to code in the system. You have colors. I find colors really interesting and easy to recognize. I can just look at a chart and say, hey, look at that. It's green, it's yellow, it's red, it's orange. I can figure out what it is without going through an entire process of trying to do calculations, looking how much above or below it is, or if it's, I put a Fibonacci retracement on there, I put a horizontal line. No work by me. The system automatically colors it in and provides all the information I need. So all the indicators are over there. Today we're pretty much, as we do regularly, going over the Commander series. That is my go-to default on all of my charts, as well as the aileron, which is a momentum indicator that is a separate indicator, separate and apart from the Commander series, but that's what I use on a regular basis as well. So let's talk a little bit about what's going on. The Fed buying everything again. Here we are. Let's kind of go back for a second and look at 2018, where we had a temper tantrum or a tape tantrum. As the Fed was increasing rates, we saw a 20% drop in markets into the low on December 24th of 2018. And all of a sudden, as a Christmas present maybe, right after that, the Fed said, you know, maybe we're not going to increase rates going forward as often and as much. As a matter of fact, I think it's time that we start to turn around our program. And you know what? We're going to start maybe buying some securities, not leveling off and not reducing down our balance sheet. And on top of that, we're going to give you a little present. We're going to reduce rates. And they said that they think they're going to be doing this for a while. So through 2019, we saw 3 rate drops, cuts throughout the year. Markets responded dramatically. Earnings didn't change very much. The economic backdrop really didn't change much. But what did happen was a 30% vault in the price of the S&P 500, pretty much lifted all of the stocks that were there. Index buying was really hot, and we saw there was a dramatic increase, stretching valuations to a point that was looking like that any wrong move by either the Fed or by companies with earnings, or maybe a shock of some sort, could be small. Nobody expected what we're seeing now would really be very, very difficult on markets, especially because the Fed, you had to wonder, like, why were they really dropping rates at that time with unemployment at an all-time low, the economy sputtering along at a 2.5% GDP, and there you go. Now, immediately, once we got the shock, the supply and demand shock from the coronavirus and the shutdown on a global basis, the Fed stepped in and said, you know, we're reducing rates. We're going down to zero. That helped to stabilize markets a bit. Then we saw fiscal policy come in. Then we get $2.2 trillion. And then in part of the CARES Act, which the $2.2 trillion is the CARES Act, part of that was money for the Fed. Part of it was for the Treasury. Part of it was for the Fed. Part of it was for the PPP, or the Paycheck Protection Program. Part of it was for the emergency disaster relief. And there was a few other billions and hundreds of billions that was baked in. But the component that was for the Fed was able to be used, and they knew, and we knew going in, they would be able to leverage that substantially. The idea was they were going to be buying bonds. They would be buying treasuries. They would be buying potentially municipals, maybe, possibly some high-grade corporates. At first, they were buying the treasuries and they were buying the high-grade corporates. The idea was they need to stabilize the bond market because the bond market was seeing very significant underlying stress. The spread between high yield and quality bonds was the highest we've seen in 15 years or so. And what they want to do is calm that down, because if credit dried up and the ability for liquidity to really dry up, there was many more problems that were going to be happening inside of markets, the grinding to a halt of the markets, than just the stock market going down. Because the credit market is pretty large. What happened is on Thursday of this week, they announced they're going to take that $400 billion and leverage it to about $2.3 trillion. And they were going to start buying below grade, below BBB rated or junk bonds of corporations. That was a big surprise. The Fed never did that before because they have an edict not to have anything that would be risky enough to lose money on their investment. Therefore, a company that has a junk bond that was issued, they were precluded from buying because the fact was that those had default risk. There's default risk on other bonds as well, but not at the level that maybe you have a bond that's a B rated, double B rated, or maybe even less than that, B minus. So what happens is now they're going in and have a chunk of money to buy up the bonds in the junk bond area. And as a result this week, junk bonds saw the greatest 1 week rise, if you look at like ETFs and some of the mutual funds, in history. We saw a drop of the junk bonds somewhere about 25 or 30% if you take a look at what they did over the last, let's say, I guess about a month. And this move was dramatic. We'll pull that up in a minute. We'll talk about that. We'll show you what that looked like. In addition to that, they're going to be buying municipal bonds. They're saving the states. Now, are they really saving the states? Are they really saving the companies that don't have the money to spend and to pay the debt service on their bonds? Probably not. But what they're trying to do is save the financial system. They want to make sure that the defaults aren't really high, that ripple into other areas for the holders of those instruments. Now, many of the companies that are junk rated, that don't have the ability to pay their bonds, possibly even though the Treasury is going to buy them, they may not have the staying power in this kind of condition where they're shut down for an extended period of time, and the probability is not for a V-shaped recovery in the economy. It's probably an elongated U, and that's going to be a problem depending on where that base is. Even if we open up the economy right away, you have to wonder how many people are going to go back to work because they're needed, how many people are going to be really desirous of opening their doors and flooding in business if, in fact, it's not safe from a health standpoint. How much of this PVSD, this post-virus stress disorder that we're calling it, is really going to impact businesses around the world? Even if the government says, okay, we're open for business, you can go back to doing what you're doing, but maintain some safe distance and maintain some healthy regimens, like possibly wearing masks, gloves, constantly washing, and social distancing. So there's a lot on the table right now that we have no idea, no one does, of how this is going to play out. So right now, we have markets reacting very favorably. Look to the right here of this chart that's on your screen, and you'll see that we have a 50% retracement of the losses. That's why I put this Fibonacci retracement on here on this weekly chart for the SPY. Simply what I did was I grabbed the Fibonacci tool, I went from the high, went to the low. Very easy to do from a Fibonacci standpoint. And this doesn't always mean that this is the absolute numbers, but you can see in combination of an altimeter point that grows across and a new altimeter that's drawn, as well as the 50% retracement level of the Fibonacci, we see right where we are is where we landed. Now what you're seeing is the talking heads on TV are like, no, I don't think we're going to retest the bottoms. Everybody a week ago or so was like, probably we're going to go and retest the bottoms. That's what usually happens in deep recessionary periods. And that's where we are right now, on the verge and probably right in the middle of a massive recession, probably the deepest we've seen since I would go back to probably the Great Depression. Really going to be very difficult. Over the last couple of weeks, you saw 16 million people file for unemployment. How many people tried to file but couldn't because the sites are down? We're here in Florida. I've been helping out people file for unemployment. It's impossible. It's impossible. You get halfway through the application, there's an error that's thrown by the website. You get all the way through the application, it says it's pending. You try to go back in to then report the week, can't do it. People aren't getting their money in a lot of areas. Same thing is true with the stimulus package by the government. The emergency disaster relief package, the $10,000 that was supposed to go out to businesses, no questions asked, 3 days after application, not happening. Not happening. The PPP, very slow with the payroll protection program, very slow. Glitches in the system, very difficult to get out. And on top of all this, what we're seeing is there's a knee-jerk reaction to add liquidity in the markets. That's what we're seeing pretty much with junk bonds, what we're seeing with stocks, what we're seeing across the range of asset classes. Why is gold in basically a multi-year high right now if stocks are reacting so well? Why are rates on bonds still very depressed? Because a lot of this has artificially been promoted by the Fed, by the stimulus package that, hey, you know what? If $350 billion isn't enough to cover the payroll protection program, we'll ask Congress for another $250 billion. And you know what happened? Thursday, the vote comes. They vote yesterday, and you know what? Knocked down. Well, they didn't even vote because they couldn't get the unanimous consent. So they voted down. And why did they vote it down? Because Democrats said, we want $500 billion more because we want money for hospitals. We want to push money into the states. We want to make sure there's money not only for the payroll protection program, but we want to make sure there's another $250 billion. Now we're talking about $2.2 trillion plus $2.7 trillion plus the we have $2 trillion that the Fed also already used, creating money out of thin air to buy assets. And then the new $500 billion is being used to add up to $2.2 trillion. Think about these numbers. We're talking about $6.5 trillion right now, right here. That's going to be used partially to pump into the economy, partially to hold up the markets, partially to hold up the bond markets, and also partially to pump liquidity in to make sure that markets operate. It's astounding. It's amazing. It's incomprehensible. So I think when we look at what's happening right now and you wonder, hey, wait a minute, we got 6.6 million unemployed this week and markets went up. Remember, the timing was really interesting. At 8:30 in the morning, the number came out for the unemployment numbers, the initial claims for the week, 6.6 million. Markets are starting to come in towards that. And all of a sudden they stopped and started turning up. And I'm thinking, what's that about? Maybe there was an expectation it could be worse. People aren't that upset. Maybe it's just a follow through from yesterday, some shorts covering. At the exact same time, the Fed announced their $2.3 trillion bond buying program. That was no accident. They wanted to come in with the numbers that were to offset the numbers that they knew were going to be horrendous for the jobs numbers. So with that, we have this slow rollout of really all of this. One of the big narratives that we're seeing right now is, you know what? This is a throwaway quarter. Earnings don't matter. You see it all over CNBC. Keep your ear out for this. The narrative is going to be, you know what? It doesn't matter what companies come in with. We know it's going to be really bad or negative or nothing. But you know what? Doesn't matter. And you know what? Maybe next quarter doesn't matter either because we know it's bad. What really we're looking for is the next few quarters outwards for a year, which no one has any visibility for. So they're full of crap. These analysts are totally full of crap, trying to tell us not to look at these and just pretty much look at the fact that sometime in the future, things will be better. So you know what? You might as well buy stocks. We're not going to go retest the bottom because now they're all afraid that they saw this giant move of the markets over the last couple of weeks. And you can see on the chart on the right, we are talking about a major move, 22, 23% in the last 3 weeks for the S&P 500, maybe a little bit more than that. And now they're just saying, you know, going with the flow with whatever it is. As the market's coming down, we're going to hit the lows, we're going to go here. Doing a calculation on where we are in terms of earnings outlook, even as a best case scenario from JP Morgan and Goldman, if you multiply that by any number, unless you're going to be extremely aggressive, saying PE ratios and multiples should be pretty much at the high levels of history, in the 20 range. There's no way we're going to get above the 2750, 2800 level on the ES. It seems improbable, impossible. Unless people believe that, you know, all this extra stimulus is going to flow into the markets. Then all bets are off. Then we have a stretched level of earnings multiples like you've never, ever seen, probably dating back to the dot-com boom when everybody was buying stocks without any earnings at all and any process of possibly being a viable company in the future. Is it possible? Yeah. That's why we use technical analysis. That's why it's so important to blend the idea of what's happening as a backdrop of fundamentals and technicals. And in this kind of environment in particular, this is where technicals shine. This is where you really want to focus in on that because you have nothing else to go with. If you're going to be worried about the economics of the situation and you're going to be saying, you know what? Things are really bad. We're going into recession and I don't want to be a part of this. I'm all out of the market or I'm all in or I'm short, whatever your story is. You can't really judge that because a lot of the information is being warped by all the excess money that's coming in, the fiscal and the monetary stimulus. Therefore, it's extremely important to take out tools that you can use that give you a very good look at what's actually happening. Momentum, technical levels, volume at price, and price at volume, depending on how you want to look at it. Bottom line is you want to know where your support and resistance levels are right now. So we're seeing a lot of move in the oil markets. Last week, we saw a big move up and then a big move down. At the close, after the close on Thursday, there was supposedly an agreement at OPEC cutting 10 million barrels per day. Pretty substantial. However, Mexico is very concerned about it. They think they're not going to do it. They've thrown a little bit of a monkey wrench. Oil closed down, even with the prospect of this happening, down 7% on Friday. What else do we have going on? Interesting right now, just to show you the breadth of the markets, if you look at the S&P 500, you look at the 200-day moving average, about 410 companies are still under their moving average, their 200-day moving average. That is pretty substantial. 90 companies are over their 200-day moving average. It's very rare that you see that, except for when you have a very severe cut in prices. And that's what we had. So, on an economic report, we have unemployment probably right now at about 12%. Right now, if we snapshot, saying we have about 20 million people that are unemployed, probably about 167, 165 million people that are in the labor force. Do a quick division, 11, 12%, something like that, depending on where we are. Next week, we're going to see retail sales probably going to look pretty grim. Industrial production also going to look pretty grim. Business inventories probably on the rise. Potentially, we're going to see an inventory to sales ratio that's going to pick up pretty well as we have no sales and we have a lot of inventory. So that's a problem. That means that that is a signal for a deflationary environment. We're going to see initial claims, probably another 5 million jobs next week. Housing starts will be interesting to watch, and we're going to have leading indicators. So with that, let's take a look at some of these. I mentioned in the chat, if you have any desire for us to look at any particular stocks, if we looked at them last week, try to come up with some new ones so that we can take a look at that. I have my list, but you can come up with some names that you have that you want to look at, that you're interested in, that you think could be something that we could all benefit from this exercise. Before we do that, I want to go to the KRI. This is the key reversal indicator. You can see that we had a multitude of magenta colors. Never, ever have I seen anything like that before. And then we started to see all of a sudden a turn from the downside where we had a negative KRI or an oversold rating. All of a sudden it got right about here, right about this range right here. It started to get very significant in the level of getting back to the zero line on markets in equilibrium. And from there, we just catapulted up. Saw a little bit of a move down. Now we're starting to see a little bit of an overbought situation. Not terrible. However, overbought in the context of a bear market or of a downtrend, which I don't think we disagree, right? We're in a downtrend here. I don't think there's any question about that. So in the context of a downtrend, what we look at is continue to watch the market. We might see further movement towards equilibrium over the short-term basis. We're favoring buyers in this kind of situation right now, as you can see that. However, in a downtrend, you have to realize that once you start getting overbought, that is an indication that things could reverse on you very substantially, back down to equilibrium very fast, as people are looking to say, you know, I got my price, I got a level that I'm comfortable with, I made some money back, I don't want to be here for the next leg of this whole thing. So that's one. The second thing I want to look at is this here, which is a very good technical indicator, or I would say a statistical indicator that blends in the idea of advancers and decliners. And you can see back down here, this is the 52-week new highs and new lows, just rumbling along the bottom. I like to use these kinds of things to really give me a perspective of what's happening. But the McClellan oscillator is now approaching 355. Now, there's two ways to look at this. First of all, you can look at this as a severely overbought situation, or you can look at it as the start of a new bull market rally, the initiation of a next leg move. We're not seeing really a lot of confirmation of the overbought from the Spearman. We did see that level of oversold that was very significant. All right, let's go over to this and take a look at some of the stocks. I was mentioning crude oil just looks just abysmal. I mean, this is just terrible. Now, the one thing you do have to notice here, and this is something you really need to pay attention to, is when are we seeing a really good hold of a support line? And again, it's very simple to do this. There are a lot of tools you can use. Very simply, just grab the horizontal line tool and just stick it right there. 2214 seems to be somewhere that crude on a daily basis wants to stay right about, because you have multiple lines that you can put together horizontally across, right? From right to left, you look and there's a lot of line there. We landed pretty much right on that. Kind of get it a little bit adjusted here to the current, right about there. And what you're seeing is that on top of the fact that you have this really good support level, that seems to be an area that there's a level of buying interest that's happening. You're seeing that there's a major divergence. Look at this, the big selling and the big trend and momentum to the downside is resolving. And when I see this, I start to say, wow, this could be an area that I would like to look at as a point of buying or starting to nibble into a stock or a commodity or whatever it is. And in this situation, you're not seeing a really great major move up. You know, down here, we're seeing a negative 70. It would be nice to see this, you know, moving higher and higher and higher. It's moving up. It's leveling off. We're starting to see a cross of the 5-day moving average from the exponential moving average against the 3-day traditional smooth moving average, the standard moving average, or simple moving average, depending on how you want to look at it. Basically, we're seeing that cross down, so there is some momentum that's being taken off here. However, now with this news that there is going to be some kind of concerted effort where we're going to see that there is a cut of production. Whether it's going to be enough or not with all the excess supply that we have out there is another question. But keep your eye on that. ZM, one of the poster childs for the stay-at-home economy, under a lot of pressure. There's some security issues with meetings. We're doing webinars here. Not the same situation, but with meetings where there's some leakage of user data, where there's some, I think they're calling it Zoom bombing, where people are trying to can figure out where the meeting ID is, get in, because a lot of people didn't use passwords before. So, you know, where there's a product that gets popular, there's always somebody trying to screw with the system. Zoom was doing very well. You got to look at another company that's in the same vein. Look at this company, Citrix. I'm not seemingly finding it. Here's a little search. I don't know what my problem is. Citrix Systems. I mean, almost at an all-time high, pretty much closing right near an all-time high, bouncing off of that. I mean, this chart looks you know, it looks rough, but, you know, we're talking about since March when it based, going right back up and crossing above, really didn't look back. So Zoom, let's take that, did see a nice move up also, but the security concerns started to cause some problems. You're seeing some crazy things happen. So I want to share this with you. I want you to consider this. So Tupperware was up 63% on Thursday. 63%. Wow. Must have gained back a lot of its losses, right? Take a look at this chart. It's not even near. I mean, Tupperware was down at, what, $1.41. It was as high as 16 back in November. It's been moving down, moving down, moving down. Excuse me. This terrible cough I've had for like 7 weeks now, just not giving up. And no, I don't have the virus. But here we go. So you look down here and you look at this situation. A 63% doesn't even look like it made a dent in the overall downtrend. You did see initiation on this right about $2. Where to close? $2.43. Point is that I want to make here, don't get really caught up in some of these massive moves. These are the kind of moves you see as a dead cat bounce, on a bear market bounce, in bear market types of events. We don't see up 4, 5, 6% markets under normal circumstances. We don't see 63% unless you have such an oversold situation. People are saying, you know what? One, this company's going bankrupt. I want to get the hell out if I'm short. Two, company says, you know, we're going to possibly restructure, reorganize, or maybe fold into another company. We'll see. 63%, great return. Is this something you could have found? Possibly. Yeah. If you were looking at a 30-minute chart or something shorter, we probably would have got you in at about $1.57. Would have been out somewhere about 206. So you made 50 cents on $1.57, 33% on a quick scalp trade. Not too bad. Is this something that you want to play long term? You may say, hey, 230 was $16. It's only got the potential to go up, right? I don't know about that. Apple. Apple has seen a major slide, obviously, through this whole process as factories have been closed. Recently reopened in some areas of China, but their retail stores, for the most part, are closed in most parts of the world. And you have to wonder if people are going to have this kind of money to spend on smartphones. Now, smartphones and companies like Verizon and AT&T and Sprint, T-Mobile, these are companies that probably a lot of people are not going to just throw out. You need to have communication, and especially because a lot of people don't have phones in their houses anymore, right? Corded phones. So you only have one level of communication. You may cut back on your plan a little bit. You may default. People may default. People may not be buying phones that often. Still, Apple was down as low as 212, currently trading at 267. When you look at this, the momentum again on the aileron started to pick up a little bit. I don't really see anything great here. Yeah, we're seeing an initiation of a new buy above a level, but it's in the context of this downtrend. And on top of that, when you look from right to left, and if we did in fact look to draw a level that would be concerning, I would say that right there, which is where we're boxed into, is an area that there's a lot of overhead resistance because we have this area of the altimeter going backwards. Now I could probably do something like put on the radar screen here, get a little bit more of a look here, and there is a lot of I would say congestion in the area that we're looking at right here. Let me clear this up so you can see this very clearly. There is a range, and this range you could use your annotation tool, your box tool. Just grab that, and you can kind of put in something like this, which makes sense. You can get above that. There may be, and especially above the area right about here, there may be an opportunity to kind of break through, and then you got more resistance at 280. So what are you really risking here? We're talking about going from 270 to 280 on Apple. That looks like the big opportunity on the upside. Doesn't excite me so much. McDonald's, you know, we're seeing that there was a major area of just absolute nothingness, right? So we can draw this very quickly and take a look that there was nothing to the left. When we look from right to left, constantly looking right to left, put that in your head. Bottom line is there wasn't really a lot right there that was an opportunity for it to have any resistance, even though when we look right about this level here, there was what we call a high volume node. Broke above that because McDonald's said, you know, we only have a 3% reduction in overall sales during this period. And, you know, we're seeing that, you know, things are a lot better. A lot of people taking out. We'll see how that plays out. That's a false one. It's just the alarm that comes on. We're going to go a little bit longer today because I think there's a few things that we need to discuss here. So this is a stock that we talked about many, many times way back. This was a great stock, this Luckin Coffee, and I want to share something with you on this. So Luckin Coffee was just a great mover for a while and then started to get choppy and started to kind of look a little bit ugly. There really was no entry points for this. You can see this on this chart. You can look at daily, you can look at weekly, whatever you want to look at. There really wasn't a lot of entry. And then all of a sudden, out of nowhere, the stock went from 23 down to about 5 or so, as there was some shenanigans, hanky-panky. There was some bad accounting done by multiple executives at the company. One of the problems you had was pre-market, I saw this at about $3.50 the day this news came out. By the end of the day, it was as high as about $6 or so. See this big move on the upside? Probably got close to about $9 on the, actually, I guess it got close to $10, then reversed down. I wouldn't get near this stock, not even for a scalp trade, and I'll tell you why. I've seen this movie before. I've seen where a Chinese company comes out with fraud, and there's an investigation about them. They halt them throughout the day, They open up, they open for trading, and then there's a halt. And that halt goes on for months. The worst thing you could do is have a stock where your money is tied up in it on a halt. Now, hopefully, maybe that something will come out of this and it'll be good. But this stock didn't even trade yesterday or the last couple of days. What day is this? 4/7, right? What's the date today? Today is the 10th. So the last time this traded was the 6th. So it didn't trade pretty much all week. It's halted with a T1 halt with no date of when this is going to come out of its halt. Jets, there's some indication that we're going to see it closed at about 1590. Last trade in the after hours last night was 1660. There's some thought that there is going to be a bailout for the airline industry that's going to be announced over the weekend. Again, strategically, this happened after the close as maybe an Easter present. If you look at this, there's a pretty good level of opening here, right? If we take that box tool that you have, you just simply draw this box. You know, you have probably up to about the $21 level on Jets. This is an ETF that is primarily, or it pretty much has airlines, small and large airline companies or related companies to the airlines business. And if you look at some of the other companies in this area, like Delta Airlines, for example, a lot of work to do here, up 9%. United Airlines, still a lot of work to do. Are they going out of business? Well, United Airlines up 23%, one of the worst hit overall, closed at 31, currently trading at 34, another 10% on the after hours when that information was released about the potential bailout. Now, whether or not we know what's going to happen about this and the companies are going to take it, because some of the bailout provisions may require the government to take back equity in the airline companies, prohibit the executives from taking very significant salaries, and also prohibiting dividends and share buybacks. Maybe some of these companies are saying, you know what, we don't want to do it. So just keep your eye on those. Gold has been hitting some new highs. Look at that, GLD. You can look at this. It's the highest it's been in a number since, I think, 2012 or so. Broke out yesterday on that announcement that the Fed is going to be printing more money, debasing the dollar. Mr. Cooper Group had a big run up yesterday. This is a company and in an area of mortgage servicers. These companies are having a really big problem right now due to the fact that they're seeing that there is a allowance to pretty much just do a checkbox and say, you know what, I'm not going to pay. I want to defer my payments on my mortgage, and they still have to pay the bondholders, and there's an inequity there. Now all of a sudden, possibly they're going to be bailed out too. Everybody's getting money. Let's face it. Real quickly, we have Yelp came out with some bad numbers and the fact that they're having some restructuring going on. You can see these wide ranges. I want to show you this on this in particular because I want to show you this range here. This is what really caught my eye. You know, we're talking about a range of 14 to 22. $8, 50 or 40% on the upside, and about 35, 40% on the downside in the range. That's really tough to play. Getting involved in something like this, you could be thrown and wrapped around a pole, put back into the market, taken out. It could be very difficult. So there's going to be a real problem for that. Last thing we have is, let's take a look at LVGO. I think it's LVGO, Livonia Health Inc. So a lot of the health insurance, health-related companies are doing very well. Is there risk on the downside? There seems to be a kind of a floating island up here. There must have been, I'm not sure what they do, but there's got to be something with COVID, some kind of release of either a treatment or some kind of a vaccine that they're working on. I'm sure there's news on this because that's what it looks like at least. Is there risk to the downside? I think your risk probably somewhere about 31.90. If it doesn't hold there, you're going to probably see a nice base at 29.48. So if you're willing to play this long term, and if you think there is an opportunity here, I think that you're just simply going to look at this at a level right there. Well, let me bring it down, get it right there for you. 29.23 is really your risk point, and then you can see a substantial drop to the downside if, in fact, it doesn't hold. So with that, I'll mention again, I want to thank everybody and talk about that you can get a 10-day free trial. In addition to that, you can get a 4-hour free coaching session. It's online. Do it at your leisure. If anybody is a new subscriber to the Commander Series, we'll give you that for free. Just email us just simply at info@triggercharts.com, and we'll get that out to you. Well, I want to tell you, thank you so much. Great audience, big audience. Tell your friends about what we're doing. Monday and Wednesdays, aftermarkets also. You can check out thedisciplinedinvestor.com. There's a link there to sign up for those. That's a big Q&A session. That is jam-packed with people on questions related to the markets and everything. I do have a Q&A here. Before we go, what do we got here? Oh, yeah, there we go. Everybody put in there. There we go. We'll get to some of those next time. We're running a bit over. Have a great Easter. Have a great weekend. Be safe. Thanks so much, everybody. And I'll see you again next week.